welcome to the Rupeeting podcast once again. My name is Ayush,
Yeah, I'm Sagnik.
and yes, we're back again with another topic for this weekend. So, if any of you all were lucky enough to even discover or have anyone remotely affiliated to this wonderful company called MRF, and if you're not living under a rock, then you must have heard that it's the first and only stock on the Indian markets to ever hit the 1 lakh per share mark. Now, this company, if I think most of us watching the podcast wouldn't be in the position to buy a stock of this volume or this number, but I think our parents or grandparents' generation is when the stock was quite a famous investment to make into. And if you did in the early 2000s, you would have made about 52 times the amount that you would have invested at that time. So if you are one of those lucky bastards in the MRF investor pool, then please get off this podcast because this is definitely not for you. But yeah, I think apart from just MRF, the entire tire industry has really done well in terms of not just financially, but share price growth has been nothing short of amazing in the past 1 or 2 years. And I think, Shagnik, if you can give us some numbers on that.
Yeah, apart from MRF, like MRF chunked in what 47% returns since the last year. But apart from that,
Yeah,
let's talk about JK, Tires, or Apollo, or CR. So all three
right,
of them scored something like 90%, above 90% in the
right.
last 1 year. So it's not just that. I mean, of course, the most expensive stock in India is a tire stock, but that doesn't mean I mean, all its peers are also really doing well in the
Yeah,
last 1 year as well. And there
absolutely.
are reasons, but yeah, the whole tire industry, whoever has been invested in this, really good for them.
Yeah. And unlike those lucky people who have been investing in these tire companies since COVID lows and have more than doubled their investment in the span of just 1 or 2 years, we are of the contrarian opinion, as usual, that there is probably no upside left in these stocks anymore. Now, of course, anything that we say during the course of this podcast in terms of an opinion is just that. And we don't intend to give you any financial advice of any kind, and nothing of this is recommendations. So let's just go along and see why the tire industry did so well, why these tire companies have doubled their share price, what could the reasons be, and why we think that there doesn't seem to be any more of that doubling happening anytime soon. So let's just jump right in. I think in general, so whenever you talk about a tire, uh, it's directly associated with the auto industry
Okay.
because this is just
Yeah,
an auto ancillary play at the end of the day. And I think the auto industry has done fairly well since COVID really took a hit and bludgeoned car sales across the board. But now we're seeing
but
20%, 15%, 30% year on year growth in passenger vehicles, two wheelers, three wheelers, and people really using up that disposable income that they had gathered during COVID and spending it on these. And automatically, tire companies tend to do well.
so yeah, it's a good benchmark. If the auto industry is doing well, tire industries do well, and
Yeah,
other ancillary companies do well.
right.
But that has been, I feel like the tire industry has done exceptionally better than other ancillary parts. I
Yeah,
mean, of course, there's software new cars, but there's the tires really did well.
yeah,
So, I mean, if you look at it, EVs are making a great play. Everyone's banking on the EV market. Then even the public transport market took a big, the trucks versus all of that. And none of these companies, if we talk about Apollo, Seat, or JK Tires, MRF, they are not well diversified in all of these fields.
yeah,
Yeah, some may be better, some may be bad, but it's just all over they're doing it really well. And it's also because India is like in every sector. Let's talk defense, let's talk automobile, anything. It's all moving towards export and just shortening the import side. So Indian
right.
manufacturers really got a really big shot at this.
Yeah, absolutely. And funny that you mentioned those specific stocks Apollo, Seat, JK Tires, and MRF. These companies actually make up the top 25 tire companies in the world, with I think MRF being among the top 10 or top 15 in the world. So India is
Mhm.
really out there, as you mentioned, with on the global level in terms of the tire industry, and they're really pushing towards not just being self-sustaining, but also growing in terms of their global position in the export market for tires. So yeah, that's also just a bit of what we're going to talk about today. So let's just go step by step, I think. Now, when we say that India tries to be a self-sustaining tire industry, uh, as I think we mentioned in one of the previous podcasts with Borosil Renewables, where the country just outright bans a particular product from being imported, and that automatically forcing the biggest players in that particular industry into benefiting from that. And that's exactly what's happened here. I think the tire industry saw a ban in, I think, FY21. So between 2020 and 21, there was a massive ban on all tires coming in for passenger vehicles, two wheelers, and trucks. So that automatically led to about 40% of the market that was left to be attended to, because that's the kind of demand that imports were uh, catering to. And that or just got cut off from the rest of the world, with these four companies, Apollo, Seat, MRF, and JK Tires, having to fill in that void. And that really helped in their favor because their financials skyrocketed from there, which we will see later, of course. But one of the other and tried and tested methods that haven't really worked out is taking on China hands on again. And that's what happened this time also. And I think, just as we had mentioned during the Borosil time, the Indian government placed import duties based on the anti dumping nature. So, China, again, being China, was able to produce tires at a very cheap rate and then sell them at an even cheaper rate, harming the domestic competition because obviously Indian manufacturers couldn't beat those prices. So, because of that, dumping duties were charged, Chinese discounts were leveled to whatever Apollo and everyone was charging. And that gave a boost, at least for the 5 years that the duties were charged, to these domestic players. So yeah, that was one reason. Then I think you can talk about the exports that you mentioned.
Yeah, so like we said, the automobile sector has been really right sector, and it's not just tires. It's like a lot of components are being exported to different countries for, let's say, tractors engines, and even like they're making literally aircraft engines in India to be exported. So, in terms of efficiency and quality, India has really amped up its operations. So,
Right.
naturally, exports rised. And after COVID, when people started buying more vehicles, exports definitely grown. And during COVID, I think there was a 7 to 8% like decrease in the tire
Yeah.
sector,
Right.
and but then it started growing in double digits.
Yeah.
So, and the tire industry, grows on this replacement factor as well, because it's not like you just fit a tire in a car and you expect it to go on. So, the
Yeah.
replacement market is pretty huge for these guys as well.
Yeah. I think the replacement market is more of a revenue accretive one for these tire companies than just the tires that the cars come with, right? Because I think
Yeah, it's bigger.
60% of at least 50% of revenues come from the replacement demand.
Replacement,
Yeah.
right.
And for obvious
So,
reasons,
in the
as you
past
mentioned,
five,
yeah, like
yeah.
please continue. Yeah.
So in the past 5 years, exports have like grown by 50%, and US US is the largest customer of the tire industry from India.
Yeah.
So even like a lot of it's not like so the exports rise because Indian firms got a lot of cost efficiency because of a lot of reduction in raw material prices as well. Raw material
Hmm.
prices decrease, the cost of rubber decrease. So the main two components that are used in a tire production facility is crude oil and its derived elements, and rubber, natural or synthetic, whatever it is. So natural rubber prices fell by a huge amount, and Even crude oil fell from around $110 to around $70 now.
Yeah. So
So
both
both,
crude oil and rubber in the just in the past year, I think they've dropped by 25 to
yeah,
35%. And I
right,
think that's attributed just to the entire global scenario of everyone thinks that they're going to go into a recession. The main
yeah,
driver for both of these products being China didn't really deliver on that whole, oh, we're coming back wala story yet. So both of those really caused, I think, what, 18, 20-month lows in both commodities
both,
were seen in the past year. So that really helped in profitability for these companies. And as you mentioned, exports, not just did it grow maybe by 50% in the past 5 years, but just in FY22, exports grew by 50%. So that one year caused such a massive like rise in exports by India, partially, of course, because China was banned from exporting to multiple countries, hence USA becoming a customer of ours because the China plus one strategy without China is just India. So that
yeah,
really helped in the export related strategy. And then just overall auto demand, all of these three, four components. So imports not coming in, these four companies having to bridge that gap, auto demand being really high, export demand really being high, and the raw material cost dropping. All of this resulted in massive financial related benefits to these companies. And if we have to look at it from a numbers perspective, these companies had revenue CAGRs prior to COVID of about 4 to 7% on like a 2 year basis. But post COVID, those numbers shot up to anywhere between 19 to 25% CAGRs in the past 2 years. So that's a massive jump just because of a bunch of uh, global or macroeconomic events that cause these fluctuations. And that's clearly depicted in investors being extremely happy with the performance that these stocks have done because prior to this, most of these stocks have traded pretty flat. And now suddenly they've seen like a massive surge. But the question arises, and the whole point of this podcast was why or will these factors even remain to be positives for the tire industry? And our thesis and research suggests no. And I think we can take it one by one and see why we think so. So, from the import perspective, I think, as you already mentioned, India being on the whole self sustaining war path and just stopping cold turkey on imports for tires or cold turkey anything, I think it's pretty established that it doesn't work, whether it's uh,
yeah,
imports or any of the other addictions that any country may face. Yeah. So same thing happened here. Four of these companies almost contributing to the entirety of the tire market in India, having to bridge that 40% gap. It's not going to be enough, especially not going to be enough in the span of 2 years. And because of the anti-dumping duties, all of this led to these four companies dictating really high prices in tires. So I think a lot of dealers in the tire industry, they have this association and they realize that they're being quoted extremely high prices and these four companies were withholding supply. So they're basically being bullies and just keeping like a bully gang amongst the four of them and facing the entire tire industry by themselves because they have the power to do so, obviously. And that
yeah,
didn't really fare well with consumers or dealers. And that resulted in them basically complaining to the Competition Commission of India. And now these companies had to pay fines. The anti-dumping duties are off. India is reconsidering the whole import ban situation because clearly these four companies, if they're left in charge of bridging that domestic gap, they're not able to do it in a fair and fine manner. So imports might be back. China is definitely back. And these companies are trying to scrape in how much ever they can from that 40% share that's left on the table. But for now, all that advantage that they received initially from the news that imports are banned and that China's out is now no more. So it's a level playing field once again, and now it all depends on how these four companies perform. From a demand perspective, Shagnik, what do you think? Do you think auto demand is going to sustain the same way? Do you think it's going to decline? What is your take?
it's definitely not going to grow at this rate anymore. I mean, see, because of COVID, a lot of people resulted in private vehicle consumption, and everyone owns a car now. Everyone owns like it's like, so the amount of cars a person owns that grew up by a lot since
Yeah,
COVID, and the EV craze, the hybrid vehicle craze. I mean, it's
yeah,
going to stay. It's just the start. It's going to stay. But
yeah.
so when news comes out, the immediate news pricing in the stock price, it happens, and it doesn't last for a long time, right?
Right.
So that's the way we should look at this. So yeah, EV is good, and things are all green. So that's going to stay for not a long time. And even if it has been incorporated now in the prices,
Yeah,
it's always going to fade away in maybe the next year or something. So
yeah.
although if EV demands or maybe two-wheeler EV demand sustains, um, it's not as shiny as it seems. So it's not a long-term thing. Tires are not going to hold like consumer staples market just because EV car market is really good.
Of course, like EV is just I think it's just 10% of all passenger vehicles, or maybe lesser right now. So clearly, those stories are very, very long term, decade long stories that will play out. But immediately, maybe the auto demand may not sustain the high levels of growth that it has seen post
See,
COVID, like you mentioned. Great. So that's the second reason already shot down. Export related reasons, I think. So as you already mentioned, 50% growth in FY22. We just recorded 15% growth in FY23 in export of tires, but that seems to be now there's already a dip in exports because China is back on the table. So
right.
if China really does buck up and propel its true nature of being a manufacturing finesser, then these exports may just continue to decline or stabilize at the current levels. Either way, there doesn't seem to be any wow factor in the export bit left in the near term. But maybe once these companies, as they've already mentioned, about 35,000 crores of capex money has been going into the tire industry in the past few years, mostly towards capacity addition. So maybe if we're producing about 10 to 12 crore tires a year now, it'll go to 15 to 17 in a few years, and then incrementally capacity addition will continue to happen. But for India to materially contribute to exports, maybe we don't have enough of a say right now when China is still in the run. So exports again shot out as a reason for being a good news trigger, or will continue to be a good news trigger anymore. Then, as you already mentioned, raw material prices. Now, if they have declined this much in a supposed inflationary period and a fearful recessionary period, most likely these prices have already priced in the possibilities of recessions or a continual inflationary environment, which basically means that if inflation is now getting better in most countries, at least in India and in the US, inflation is seeing decline. The possibility of recessions are reducing for major countries, but maybe the European region is still subject to risk. But still, the possibility of these prices dipping further is unlikely. Staying at these levels is possible. But further profitability growth on the basis of raw material prices declining from here is again an unlikely event. Hence, that fourth reason also being shot out of the water. So four reasons that we mentioned that drove the prices to the 130% rallies that we've seen in the past year, with no valuation re-rating happening on an EV EBITDA basis or a price to earnings basis. So most of this rally has been off the back of extreme profitability and revenue growth that is not in line with historical averages, or just news related pumping of the stock that has resulted in these high share prices. So that's the
Yeah.
story. Now, this doesn't mean that we say that the tire industry is shit or that these stocks may not rise. There's obviously always room for upside. But from the current look of it, any of the triggers that may present itself are very, very long term. I think, for example, as we already mentioned, the capacity addition, for that to actually materially affect revenues, it's at least 5 years down the line. So holding on to these stocks at current prices based on a 5 year long story may not be the most ideal, since the valuation re-rating has not happened. And that means that it may not happen also. Secondly,
Yeah.
and I think this is an interesting thing that we came across during our research. Now, there is a governing body for tires called ATMA. All I'm unsure of the entire full form of the term, but they, in correlation with Apollo, SEAT, JK Tires, and MRF, are now spending about 1100, 1200 crores on setting up India's own rubber plantation, or rather expanding the current rubber plantation capacity that we have. So, as we already mentioned, there is an import substitution happening for tire products, but there's now also an import substitution happening for rubber as a raw material as well. Because even prior to this, or even currently, 40% of all rubber is still imported, and 80% of all rubber is used by the tire industry. So, the direct beneficiaries of import substitution for rubber would be the tire industry. Hence, the personal vindication or conviction being shown by these tire companies to expand the raw material that they use. And I think that's also a very, very long term story, because the saplings have literally just been planted. So the
Yeah.
northeastern region, which accounts for the largest rubber plantations for the tire users that we have in the country, is going to grow by around 15, 17% only by 2030, 33, because that's how long it takes, obviously, for a plantation to come into fruition enough to be a sustainable source for these tire companies to quote unquote exploit. So again, another good trigger, looks great on the news, makes a killer headline, doesn't make a single difference to profitability in the near term. In fact, for all you know, since rubber is not that cheap to produce, it may not make that much of a difference whether it's imported or sourced from the domestic market, since the domestic market supply is low and imports are just expensive. So that differential won't be very different.
Yeah. It'll just be offset. So
Exactly.
basically, you're just late to the rubber party. And if you still want to
Unfortunately.
get into the door, just buy the pass and wait for the doors to be opened in the maybe next 5 to 6 years.
Yeah. Which it will,
So
for sure it will.
yeah, it
Every
will.
story always fizzles out, and this one is another story that's fizzling out. So if you were lucky enough to be on this ride in the past 1 or 2 years, then good for you, man. You can get off this podcast and uh, continue to make money or book your profits whenever possible. But if you've missed out, as Sadmek already said, then oops, because we also missed out. So we're also pretty salty about the fact that we didn't make 130% returns on our portfolios. This entire
Right.
podcast is just a
But
rant
it's
for why
okay.
the tire companies suck.
There's another time, so it's okay.
Yeah, absolutely. There'll always be another time to buy in, because it is a solid industry. I think currently,
Yeah, it's the industry
uh,
we are talking about.
yeah,
It,
exactly. So from an industry perspective, it's pretty solid. I think right now the turnover for this industry is what, 60,000, 75,000 crores, and it'll go to like 1 lakh crores in the next 4, 5, 6, 7 years. Again, another long term story, but it proves that the tire industry is a good place to be. It's just the timing, I guess, that matters, because for those of you who were early, you really killed it. And those of you who are here on this podcast and crying with us, you won. Yeah. Pretty
it's
interesting.
okay.
Keep a watch out for these tire companies. And if you already have them, then of course, not a recommendation or not a suggestion of any kind, but it's probably time to book those profits. So yeah, watch out and stay safe in the markets. But it's a good place to be, much better place to be in India than anywhere else right now. So keep looking out for these opportunities. And if you don't know how to look for them, then we're coming out with ones every week anyway. So stay tuned for the next episode of the Common Sense podcast. And thank you for watching 20-ish minutes of this rant of ours. And we'll see you next week.
Cool.
Okay. And that's a wrap.